This video will introduce you to the topic of divergence. In this video, you will learn what divergence is, how you can find divergence, and the different types of divergence. Divergence is a concept that can allow you to find a potential price reversal ahead of time. It notifies a trader to a potential change in current market conditions, indicating a possible slowing of momentum, which could lead to a trade opportunity in the opposite direction to the current market direction. Divergence identified on a higher time frame has a higher probability of working out than divergence seen on a smaller time frame. Generally, an indicator will move in conjunction with price. If price is making new lows, then the indicator will also make new lows. The two most common types of divergence found are called bullish divergence and bearish divergence. In this example, we will look at bullish divergence. When price makes a new low but the indicator makes a higher low, it is called bullish divergence. Observe that while the connection between the lows on the price chart form a downside angle, the connection between the lows on the indicator form an upside angle. This normally precedes price moving in the opposite direction, potentially setting up a long trade. We will now look at what bullish divergence looks like on a chart. You can see price makes a lower low, but the MACD indicator makes a higher low. This is an indication that we may see a move in the opposite direction. In this example, we will look at bearish divergence. When price makes a new high, but the indicator makes a lower high, it is called bearish divergence. Observe that while the connection between the highs on the price chart form an upside angle, the connection between the highs on the indicator form a downside angle. This normally precedes price moving in the opposite direction, potentially setting up a short trade. We will now look at what bearish divergence looks like on a chart. You can see price makes a higher high, but the MACD indicator makes a lower high. This is an indication that we may see a move in the opposite direction. Common indicators used to find divergence are the stochastic indicator, the MACD, and the OSMA. However, almost all indicators can be used to find divergence. So far, you have learned that divergence can show a possible reversal in price action ahead of time, and it occurs when price moves out of sync with the indicator. Bullish divergence occurs when price makes lower lows and the indicator makes higher lows. Bearish divergence occurs when price makes higher highs, but the indicator makes lower highs.